Hello and welcome to Trading with Technical Indicators. My name is James Boyd. Today's date, July 14th. We have also Ben Watson with us in the chat. The Ben Watson, we welcome him. We welcome all of you. Hello, Gary, WW or Will W, Dom, Skylo, Elena, Fayez, Dragon Rider 108, and many others. Welcome to all. Hopefully you had a great weekend. We're right back at it and got a lot to talk about here today. What we'll do is we will take a look at we're going to have a follow-up discussion on our topic from last week, and I will show you that in just a moment of what we discussed last week. And I think it's going to be helpful to actually talk about some color around the strategy, especially as we're going into earnings. Now, just remember that Ben and myself, we do post educational content on X. Ben, if you could post your handle right in the chat. My handle is @JamesBoydCS. What you need to actually understand is X is really how traders kind of talk to each other and they share information, okay? If you went to my Facebook page, I don't post a lot on Facebook, okay? But X is kind of more of a business tool. So it's a way people share information. Now, in our world, what we do is we share educational examples. We also kind of give updates of what's going on out there in the marketplace, etc. So that's how we use it. They're not recommendations in terms of our posts, but it's actually really examples of what we talk about in our sessions and also announcements as well. So join us. Just real quick as we get started, remember the information here is provided for general informational purposes only. When we talk about options, probably half the time, options carry a high level of risk, not suitable for all investors. Also understand that when we talk about examples, we will do those on the Paper Money software application, provided for educational purposes only. Also remember that investing involves risk, including loss of principal. And today what I'm going to do is just quickly, okay, we're going to go over markets and sectors. And then what we're going to do is we're going to go to talk about 4 trade examples right after that. And then what we're going to do is we're going to do a follow through of what we discussed last week. Speaking of that, what did we discuss last week? Well, this link that I'm sending to you now, this right here is a link of the playlist from this class. So if you said, James, I really enjoyed this class, can I actually get a playlist where I can bookmark it to your search page? If you use Google Chrome, Safari, whatever you use, you can just click the star and it's just going to save it in the bookmarks. Now, the biggest thing is last week we talked about bullish with protection as well. And I want to kind of talk about more about some of that on the back half of our discussion here today. I know there's a lot of people when you could show them a trend, it doesn't mean they wrote even $1 of it, okay? And there could be trends and trends and trends and trends. And a lot of investors sometimes just kind of watch from the sidelines and say, geez, as they say in the South, must be nice, okay? And there's a lot of people that just they're good professional watchers, but they might not really be trading what they're seeing. Do you know anyone like that? Okay. Now, so I'm going to kind of get into the back half of this and as far as that topic. Now, in the 4 trade examples that we do, we'll talk about that strategy, but just know in the back half of our discussion, we're going to come back to this. Okay. So if you said, I didn't even see that class from last week, well, that's your first part of the homework assignment. Okay. Now, just real quick, let's take a quick look at where the markets are. Since we have the Dow up, let's just take a quick look at it. Now, the reason why we talked about the strategy we did last week is we kind of thought the market after a big run to the upside might consolidate a little bit. That's a pretty simple idea, right? We know that if someone is thinking the market is going to pull back, if they had, let's say, 100 shares or 100 delta, well, what they could do is they could actually alter the delta on the position down. And we talked about that last week, okay? We talked about it. Wonder if the investor wanted to keep the 100 shares, but then sell a call, okay? Sell call. Wonder if the investor said, well, James, that's income strategy, but wonder if the stock really goes down. I want to have a right to sell it. Well, that's what a long put is, okay? I'm going to tell you right now, I've said this before, but I want you to really listen to it this time. There's a lot of people that know about long puts, haven't done a long put in their whole life, okay? So there's a difference between reading about a strategy and actually saying, I have done the strategy. There is a difference, okay? And that long put, that is the right to sell from now until expiration. And we hit that last week. We said the investor can exercise that long put by simply just clicking on the long put, and it's going to sell the shares at the strike price. Okay? We showed that last week. So what we did kind of last week is we were kind of thinking that maybe the market might consolidate a little bit. If we're talking about the Dow, it's done that so far, and we've kind of had that moving average crossover. We're following the indicators. And the indicators, when the price drops down below the moving averages, the momentum tends to cool. The prices are still below the moving averages. And especially when we're below the 10-period moving average, that's telling us we have negative momentum and we could be in a flag condition. Now, does that necessarily mean it's super bearish? No, we didn't say that, right? You just come off this big rip to the upside, there can be some consolidation. Consolidation does not mean bearish, okay? It could just be some pullback from the high. Now, just quickly, SPX, are we seeing anything different? Do we need to mention anything different? Well, the one thing that we would say maybe different on the SPX, it's just a little bit more sideways than the Dow is. I mean, if this is where we were last week, we're pretty much holding right where we were from last week. Now, from the strategy discussion we talked about last week, that's perfect. Because the idea was that it could go neutral to slightly bullish. So far, it's actually kind of played out, okay? If we're talking about the indexes, and if we look at the NDX itself, if we look at the NDX and say, well, what about this one? Well, same thing. We could actually say that this is where we were last week or so. Let's go back to the 7th. 7th was right there. We're modestly higher than where we were before, but not by much. The one positive thing we would say about the SPX and the NDX is so far not much of a pullback yet. Now, what does that kind of tell us about the posture of the market? The sentiment still quite strong. Okay. Now, Russell, if you like to look at small caps, there was someone who actually kind of posted some content about how institutional investors are very bearish, the small caps, and I was like, wow, they must be losing a lot. Because the small caps have been really quite a surprise, and they're trailing behind the other indexes, but they've come a lot closer. They trail by a lot, okay, but they're kind of coming more in line, okay? So those institutional investors that have been going short or bearish the index must be painful. And if they're talking about trading the trend, they're not, okay? Because the trend has been going back to the upside. Clearly, they're speculating that index could go down, and that has yet to be seen, okay? Now, if we take a look at also just real quick, the sectors, okay? When we look at the communication, okay, we know that when we have upward trends, there can be classic flags. Now, I think in the world of technical analysis, flag is probably a word that's overused, okay? You get these little runs to the upside, and the flags are where you really have the red candles. And you get the poles, the green candles, and the flags are the red candles, right? And so on. And we can kind of see this, it runs to the upside, flags, kind of more of the red candles. I'm circling the flags. Run to the upside, green candles, and then the flags are kind of more where you see red candles. But if we kind of take a look at communications, I just want to point this out. The old highs really turn into new potential supports. So the old resistance is becoming new support, okay? Now, if you take a look at this, communication, if you like to buy on a little bit of a dip, okay, now, communications is right there. You're probably going to pay attention to that this week. And you're probably going to be thinking option number one, the investor might consider buying the sector. Maybe, right? Second is what stocks are leading in that area. That's a question for you right now. What stocks in that area are leading the sector? You got 30 seconds to type in the answer, okay? When we look at financials, we're seeing something very similar. We saw a recent brand new high, and now it's checked back right back down to where the old breakout area was. Probably the second area that we're going to be watching here today is financials. Well, I want to say today, we're going to be watching this week to see can communications, can financials, can they give a little bit of a bounce here today? And they are the leading sector going into the earnings, of course. When we look at industrials, I feel like it's Groundhog's Day, but it's a good Groundhog's Day. because the Groundhog's Day has been new high, new high, new high, new high, new high, new high. And bullish investors don't never get sick of new high because that new high was actually made on Thursday. And we're not even that far away from a what? Guess what? A new high. Now, again, I remember when I told my dad, I said, Dad, you've told me that 100 times. And my dad swiftly said back, yeah, but you haven't done it once. Okay. And that's kind of similar to technical analysis. You could see a chart 100 times and never have wrote it once. Now, we hit industrials pretty hard last week. I'll come back to those in a little bit. But there's a number of stocks in there, from Boeing to Caterpillar to RTX to Triple M to Honeywell, that are actually getting a little push. CMI and DE are probably the other ones that we're probably going to keep an eye on as well. Just quickly want to kind of point out, when you look at, let's say, the discretionary sector, that's also kind of right on that edge of maybe a continuation pattern, it's discretionaries. When we talk about discretionaries, of course, we're talking about Amazon, maybe being one of the leaders. Could that lead to the upside? We'll come back to Amazon. Boy, a lot of things to come back to. That's true. Now, keep an eye on transports. We talked about those heavily, and I'll just leave it at that. So probably four sectors that kind of stand out. Discretionaries, a little continuation pattern. Communications and financials at a bounce spot after it's right at the breakout area. So just check back, potential bounce setup. And industrials floating away. Could it go higher? Okay. Now, what I want to do is I want to kind of talk about, we've talked about in the last couple of days, okay, 2 weeks or so, 10 days or so, about that kind of correlation and that new asset class. And I want to kind of go back to one of the stocks, and I'm going to start with, just real quick, let's actually start with Palantir for just a moment. Now, there's something I want to kind of take a look at Palantir. Now, Palantir kind of goes back to what we just talked about, okay? Old resistance being new potential support, okay? Now, if you take a look at this, you kind of see that same type of setup where it kind of broke out, it ran up, and then it checked back. Now, first off, what you're now going to notice is, are red candles, are they all the same? Well, let's take a look. A couple days ago, we actually had some pretty good selling pressure. And that pretty good selling pressure led to large candles that smashed down to support. Now, so first off, the size of them, right? How big were they? Did they fall down below the support in the whole 9 yards? And those did. Now, when prices fall, what the investor is always interested in watching is, does it get bought back up? If you get hard selling, big fat red candles smashing down to support, can you get buyers to step in? And how do we know if they're starting to step in? Well, if we're starting to see some investors stepping in, we're just going to be watching to see, do we get the moving averages to turn green? That's day one of the 10-period moving average turning green. Day two of the 10-day moving average turning green. Day three of the 10-day moving average turning actually green. And you're also going to see that there's a little crossover right here. I'm going to tell you, this is what's kind of interesting about technical analysis. Sometimes the entries are not complicated, but it's kind of like the psychology of the investor to trade what they're seeing. That's harder than actually the indicator, okay? And if you look at that, on that crossover, that's when we had the 20-period moving average go green as well. Now, I want to take a look at Palantir. We have been talking about momentum lately, and we've been talking about when we get pullbacks, there might be a pullback of 1 day, 2 day, 3 day, etc. Now, one of the misconceptions is, well, do you want the stock to pull back 3 days? You serious? If you were bullish, do you want the stock to pull back 3 days? Well, that's my same answer. No, I don't want it to pull back 3 days. But a lot of times we'll kind of see the stock pull back, and you're going to see this where we pull back 1 day. When I say pull back, I mean red candle. Be 100% clear. Okay? Don't want anyone to say, I'm not clear on what the down days are. They're the red candles. And then we actually see down day again. So in this case, We had the example where it was down for 2 days, okay? Now, James, do you want it down for 2 days? Look, if you're bullish, do you want it down for 2 days? No. Now, if we had strong momentum, it might only pull back for 3 days or less. Which is the better example? Oh my gosh, if you only pull back 1 day, that'd be the best example. 2 would still be good, and 3 would be fine. But really, if you pull back 3 days, you start running the risk of the prices falling down below the moving averages. Do you get that? Okay. So obviously, if we're bullish, or we're doing a bullish example on the paid money account, we'd like to see the pullback only down 1 day. But sometimes it might be 2 days and then 3 days. But if you go down longer than 3 days, we're now wondering, are we really starting to really get a shorter term bounce setup? When we see prices only pull down 1, 2, 3 days, that is what we would call a short term bounce setup. What do we see on the chart here today? What do we got? Well, what do we actually have on this chart here today? Our first trade example is we kind of see like a classic U pattern. What is a U pattern? Well, the U pattern could be where the price drops down and where it swings back to the upside. Now, you might have that question, James, could this also be a little cup and handle? A little one, okay? A little tiny handle, but not much of a flag there. Is that a bad sign? We just went over that, okay? Now, what you're now going to notice is these little U pattern short-term cup and handles, these might be what some technicians call a continuation pattern, meaning that maybe the stock might try to make a new high relative to here. They don't know if it's going to, but they're speculating. Shh, don't tell anyone, okay? Now, what I want to do in trade example number 1, let's kind of show an example where the investor, and I'm going to do shares of stock. Sometimes I feel like we talk about options, and then someone who trades stocks, they kind of feel like, well, hey, I didn't feel like anyone talked to me because we talked about options, okay? Now, when we talk about stock, just understand that we could talk about an option, provided that there's liquidity. But I'm going to talk to those stock investors here, okay? Now, no one says you had to do options. You could do a blend, you could do none, okay? It's up to you. Now, what I'm going to do is when I go back to this for just a sec is we're going to bring back up the Palantir, and I'm going to zoom in on this, and I'm going to right click on the current price. Right click, buy custom, and I'm going to go with OCO bracket. So if we kind of said, well, what indicators are we using? We're using the price indicator. We're using the momentum indicator, okay? The shallower the pullback in terms of percentage, the shorter the pullback in terms of duration of time, maybe the stronger that trend. We're trying to trade the momentum. Now, what I'm going to do is I'm going to use today's open price as a place to set a stop below that, okay? Now, where is that? It's at 142.67. So if I take 142.67 less 2%, it's going to be at 139.81. So if I type in 139.81, let's go back to the position size, okay? It's not about, well, what do I want to do? It ain't about that at all. If we said, hey, the position size example given is $5,000, it's really going to be about 34 shares of stock, okay? Now, sometimes when we have a smaller portfolio, this portfolio is at 34,235, okay? So the biggest thing is when we started this portfolio, we were taking positions about 5,000, 6,500, no more than 6,500, okay? And if we did this in terms of the number of shares, we're going to do 34 shares of stock. We got the stop, data GTC, and now we're going to kind of look and see, could there be a target? Now, if we wanted to kind of have a shorter term target, these prior highs, when you get U patterns, V patterns, continuation patterns, etc., some investors might like to use the Fibonacci to kind of see where that extension could be. And if we just use the Fibonacci numbers by themselves, that at 161 extension, 153, 261 is going to be the 168. Some of you might like to use the 200% extension, and this paper money account is a fan of that. And that 200% is not a fib. All that really is, and I feel bad for those who don't know this. I feel bad, okay? What it is it's just using support to resistance and then adding that on top, okay? And that's going to give us a target right at 159.22. Now, I'm going to imagine that we're off some. And so we're going to put a target a little bit less than that. Let's say 158.50. I'm trying to get in the area, okay? And I'm going to put the target right at 158.50. Now, my question is to you. Can you name me any examples that you have practiced in your paid money account where you actually said, James, I have practiced some of these stocks above a 10-day moving average, and I have practiced a stock or an option position where these stocks have pulled back 1, 2, or 3 days, and then a bounce, and I've been practicing those lately. Type in the chat, have you? What stocks have you been practicing them on? Let me know. I won't tell anyone. Now, what you're going to now see is I'm going to go good till canceled, and now what you're going to see is there's the setup, okay? Now, remember how the stop order works. It's saying, look, if the stock is purchased, that's number one. Stock is purchased, then the stop becomes valid. If the stock goes to this price or less, it's triggered to be sold. Not at that exact price level, perhaps. It could be lower than that because that stop order is a market order. So that's the risk of the stop order. It's a trigger to be sold, but we don't know where that fill could be, okay? And there's reasons for that. So what we're now going to go ahead and do is we're going to send the order, and now we see, did it fill? It did. And now what we got right there is the target right there, and then we got the stop underneath, okay? Now, by the way, I want to also go back to just real quick, coin for just a moment, okay? So some of you have been watching some of the discussion we've been having about that new asset class. You've also been kind of maybe watching some posts that we've done over the last couple of weeks and kind of some updates on what's been happening out there. One of the stocks, sometimes what investors like to see is they like to kind of see something where there's been a recent up move. Now, remember, when you get this recent up move and you see a whole bunch of green candles, they don't have to all be green candles. When you typically see like a pull, it normally is 5 to 8 trading days. That's a pretty normal pull. Normal does not mean all the time. It just means when you get a pull of price upward movement, the pull tends to be 5 or 8 days, and then you tend to get a little bit of consolidation. Okay, now, of the 5 to 8 trading days, are there any of those days, the 5 to 8, that tend to be down? Yeah, a lot of times you'll see maybe 1 or 2 red candles in that 5 to 8 trading days. So it's not just going to be green, 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 okay? There could be a red candle in there, but it doesn't necessarily mean it's not still a pull. Now, let's count together. 1, 2, 3, okay? And now what you see, lo and behold, here it comes again, okay? Here we get a little green little dot. What do we have here? Can we get the price back above the 10-day moving average? Can we get a little green on that moving average? So if someone said, James, where was the first moment the 10-period moving average started to go green? It was right there. So let's kind of mark this as number 1 right there, okay? Now, day number 2 of that, day number 3 of that, and you're going to also notice on day number 3, the 20-period moving average also. So if you said, James, I want to see both. I don't like to get in that first, just the 10-period moving average. I want to see both, okay? And I say it like that because I want to express there are some people that says, I want to see more confirmation. Now, if someone said, James, I want to see the green lines and the moving average crossover, well, that happened Friday. But today's not Friday. Today is Monday. What do we have here? Now, do we have a setup? Yes or no? Now, if you take a look at this, I'm also kind of seeing maybe a little W pattern. A little run to the upside, a little pullback, a little run to the upside. This kind of looks like a little tilted up W pattern, okay? Now, it also kind of looks like now we've said this a couple times here today, but that's okay. Want to make sure I get it through my thick brain. Maybe I can convince myself. Well, now all of a sudden, as we kind of see this hold high, and is this maybe turning into the new area of the old resistance, turning into new potential support? Yeah, now we could say, well, it's too high. Well, new high is confirmation uptrend, okay? Now, if you take a look at this, the investor might say, James, I'm going to set my stop underneath the moving average, the 20-period moving average, the 10-period moving average. Or they might say, James, I'm going to set it a little bit lower. Now, what we're going to do is we're going to use we're going to kind of use a vertical, okay? Now, why a vertical? Well, some investors might say, well, James, this is $395. And with $395, you can't buy that many shares. Well, we still did the paper money count. Doesn't necessarily mean it can't work, can't gain or lose. The example that we did in the IRA, bought 9 shares of stock. It's not a ton, but again, it's just based upon account size, right? Now, what I'm going to do is I'm going to come back to the margin account for just a moment. We're going to go to the trade tab, and we're going to do a short put vertical. Now, if the investor said, James, we like to kind of look to begin with that delta of 30 to 40, which is stating the probability of being in the money at expiration. Second, which is also kind of stating approximately the move in the option price. Think of it as a conversion. If the stock moves $1 up or down, how much does the option move by approximately? Stock goes up or down $1. Okay, the option moves approximately 38 cents for the first dollar movement, approximately. Well, if we take a look at this, what we're going to do is we're going to sell the 380. Now, wait, if you sell the 380, the investor might be more. Now, they could be greedy. Let's just get that out there. They could be too optimistic. If you sell the short put strike closer to the current price, you are more bullish. We said you could be greedy. Could be just too optimistic, okay? And so if someone's trading the 380, 370, they're saying, James, my technical analysis, that investor says, they are more bullish. So let's kind of play that route. That the investor says, I'm not going to sell like 370, 360, that this trade example on the paper money count is going to be a little bit more bullish. Well, how do we know if we're more bullish? Well, the credit is bigger. How do we know we're more bullish? It has a higher delta, okay? Greater risk of actually being in the money at expiration. Now, we're going to trade number 2. We're going to sell the 380, and then we're going to buy the 370. Do we really want the 370 to be profitable? No, we don't want the 370. What's the point of the 370? Reduce buying power. Second, create the max loss, okay? What's the side of the trade we want to really win? Answer is the 380 put. That's the bullish side of the trade, okay? Now, trade example number 2 is we're going to do a short put vertical on coin, okay? And you're going to see there's the maximum profit, the maximum loss. The max profit and max loss kind of almost looks more like a long call vertical, if you will, where it's almost a one-to-one. But we know how that's the case is because we're selling a little bit higher and the delta is 38. Now, I mean, is it outside the range of delta 34? No, it's just on the upper end of the range. We're going to find out over time, note the commission. We're going to see if that stock can't continue to push to the upside. Now, I won't get into these other two because I want to talk about our second kind of discussion point. We also kind of brought up the comment on Hood, which also made a brand new high here as well. And also the other stock, MicroStrategy as well, okay? Now, last week we talked about, let's go back to this. We talked about bullish with temporary protection and the strategy. Can anybody remind me of the strategy that we talked about last week? Does anybody remember? What was the strategy? what was that strategy that we talked about? Okay. Now, the strategy that we talked about, now I'll just bring it up just real quick if you don't mind. So as I'm getting some answers back, I'm going to come back into the paper money. So as you're giving me some answers, I'm just going to bring up the strategy. And I'm going to bring up Hood for just a second, and I'm going to duplicate what we discussed last week. I'm going to buy the shares of the stock. Step number uno. Step number two, first triggers SEQ. And then what I'm going to do is going to go down to the options, the monthly options, 20 to 50 days expiration, the 15 August. And we're going to sell the call with a delta of 30 to 40. And we're going to buy the delta of 30 to 40. This is exactly what we talked about. Now, in our example, I'm going to go a little bit lower on the put side. Why? Why? Well, because normally we like to kind of do the caller piece, selling call, buying the put, for a credit. Or we try to actually have something where there's a zero cost. If we bought the 95s, the puts are higher than the short call premium. Okay, so it's going to be a debit. Okay, so we're trying to have maybe a zero cost and or a slight credit. That's why we're looking at the 90s. So how do you put that on? Right click on that right there, the bid of the 110, sell, and then we're going to go to collar synthetic. That right there, if you take a look at this, we have to make sure that we actually have the strike that we need on the put side. And if we did that, this is what we brought up. And that's what I mean by a slight credit. So what this really means is we get up to the 110 cap, if we look at the option, but there is also a credit as well. So it's like we're making up to the 110, add the credit, 95 cents, okay? Now here's the thing. Strategy is like the kindergarten or first or second, third grade part of the discussion. The management of any strategy is really where you get to the sharp end of the pencil. Let's kind of talk about this. Now, over 10 years ago, we kind of wrote some sample management criteria for callers. I want to review that, okay? And I think this is going to be helpful in kind of giving us some context, okay? I want to just bring up just kind of a blank sheet of paper, and I want to just kind of write on something, okay? So when you practice a strategy over and over and over, I'm talking about hundreds of times, okay, you kind of get to where you see examples of what are the frequent things that happen, okay? And you also kind of back test maybe how you as an investor might want to trade that strategy. Your experience is your right. No one can take it away from you, okay? It's your experience. And then what you do is you take your experience and you decide, is this something you would consider? And if you are going to consider the strategy, how would you want to try to manage the position? That doesn't mean you're always going to be right, but you're trying to say, in most of the cases, on a high probability basis, this is probably how the investor might consider, or for yourself, how you might want to consider managing a trade, whatever strategy it is. Now, what we're going to do is we're going to kind of label this number 1, number 2, and number 3, and I'll just leave it here, number 4. Now, what we kind of found is there's situations that happen. The first situation is kind of bullish. And what I mean by this, you put the collar on, okay? You put the collar on and the stock goes to the upside, okay? Now, we talked about that a little bit on Friday. So the situation is we put the collar on and the stock goes bullish or up, and we're now saying to ourselves, now what? Okay? Now, I'm going to kind of put this in capital letters here because it's important to emphasize that. After 9 or 10 trading days, after applying the collar. Now, that's very important. I'm going to write that. I'm going to see if you ask me a question on that. Do you have a question on that? Okay? So after 9 or 10 trading days, after applying the collar, the stock breaks up through resistance, okay, or a new high, okay? I'm going to write right here, the long put will typically be worth less than 50 cents, okay? The investor might consider using that for a right to sell till expiration. In other words, if that stock goes to the upside, the investor looks at the long put value, and we saw this on Thursday. Someone might say, I'm going to sell the long put, I'm going to sell the long put. The problem is, as the stock goes up, the put value, the long put value typically goes down, and there's not a whole lot to sell, okay? And so the investor might consider using that. What's that? The long put as a right to sell it to expiration. Another way we could say this is really the defined risk, okay, of the trade. Now, the big actually thing is here, the one thing I want to highlight is the investor could identify resistance and set a buyback or the short call add 1 to 2%, example given, for the buyback. Okay, so let's stop for just a second. So why is the resistance such a big deal? Well, if you get the stock to break resistance, maybe that stock is getting out of the range. So when you did the collar trade to begin with, you kind of thought the stock might go sideways a little bit, okay? So if the investor says, James, I have identified resistance, and let's say example given $100, example given, and the investor says, I'm going to set a buyback 1 to 2% above the resistance. Easy math here, okay? We're going to use $100. If we did 1% above 100, it'd be buy the call back if it gets to 101 or higher. If we did 2% above 100, it'd be 102 or higher. Now, why did we use the language after 9 or 10 trading days? If you've done a lot of these trades, you'll kind of notice that just because the stock makes a new high 2 to 3 days after, a lot of times that stock might come right back down inside the range of the short call and the long put. So when you back test it over and over and over again on a high probability basis, you might notice that, hey, if I buy the calls back in the first 3 to 4 days after I put it on, and I exit the collar position, or at least the short call, I tend to get whiplashed a lot or whipsawed a lot. And I think you might find that, okay? Now, I'm throwing that out there. You might find that. So that's why in this rule, if the stock goes to the upside after 9 or 10 trading days, so that's the key. After 9 or 10 trading days, the investor, number one, identifies resistance and can set a buyback 1 to 2% for the call. If you buy the call back, it uncaps the upside potential. You no longer have an obligation. Now, situation number 2. This is prior to 9 to 10 trading days. This is prior to 9 or 10 trading days, okay? And what you're now going to notice is this is prior to 9 to 10 trading days, and the stock breaks to the upside. Whoop, upside, okay? So you put the collar on. 3, 4, 5, 2 days later, whatever, 5, 6, 7 days later, what you see is the stock shoots to the upside, and now the investor says, oh my gosh, I'm so frustrated. Well, you got to remember something. Your trade the pay money trade still actually has, the investor has a max gain, okay, on the call, or I should say the collar entirely, okay? Can the investor exit the protection and sell the shares and just get that maximum gain? Sure, okay? Now, if I went back to this and I just kind of showed this for just a second, James, could we see what that would be on Hood? Absolutely. Well, let's just say we bought these shares for 100 in the paper money as an example. We could do the math in our head. We don't need to have a PhD in math. We buy the shares at $100 and in the paper money account as an example, and we sell that call at 110. What's the gain on the shares? Can you tell me what the gain is on the shares? Just basic math. Buy the shares at 100, sell them at 110. What do you got? 10 bucks. But it's not just $10, it's also the credit. And if we add the credit on top, 95 cents, the maximum gain on the collar is $10.95. Now think about a regular like long call vertical, short put vertical, cash secured put. This is the most the investor can make given the collar strategy. Now, does the investor try to get all of it? James, that's a trick question. The answer I want to say is yes, but I know if I read that or if I type that, you're going to read that and embarrass me in front of the whole class. I would never do anything like that, ever. Maybe. Okay, here it is. Some investors say, James, I'd like to get 50% of that. I'd like to get 65% of that 1085. I'd like to get 80% of that 1095. If that investor got all of it, that's an incredible trade, okay? This is the most they can get pre-commission. What's the commission? It would be less than $1.30, okay? If they actually exit out of that position. So understand think mentally, just like a spread. If you had a spread that you could make at the most 1095, whether it's long call vertical, short put spread, cash secured put, whatever it is, the investor is trying to get a portion of that. Now, if the investor got all of that in the paper money account, I've said that a million times here today, that's amazing. Is this paper money account expecting all the 1095? No, it's not expecting all the 1095. If that stock, though, closed above the 110, could it make 1095 less the commission? It could, but the key is you got to hold closer down to expiration, or the stock and close above the strike price, or the stock has to go up a lot above that strike price. Okay? Which strike price? The short strike price. Now, what I also want to kind of do is let's look at this last scenario for just a second, okay? So this is kind of the bearish example. So let me go back to this. The stock prior to 9 or 10 tradings, the stock breaks up to the upside. The investor has a maximum gain on the collar. You need to review those numbers, right? Review percent of max gain. We just talked about that. Now, if the investor sees that stock's going to the upside, some investors keep the collar and they're trading those percentages on the collar trade. Some consider selling a put to try capture the upside movement. Now, that's up to the investor, okay? So if they say, James, I put on a collar last Monday. Here we are, 5 trading days later, the stock is now shooting to the upside. What do some investors consider? They might not consider touching the collar. They're going to play the percentages out on that. Some investors actually say, look, what I'm going to do is I'm going to go ahead and actually try to just sell a put on the same stock position, okay? They're going to try to sell a put on the same ticker symbol, okay? And try to increase the delta on the position as a whole. Now, James, is that risky? It is risky because that's the obligation to buy more shares. So you need to understand the investor needs to have capital for that. Now, let's kind of speak to, let's say, if the stock actually goes down. So this is bearish, okay? We're talking about, hey, James, we put the collar on and the stock has actually gone down, okay? And I'm going to write here, the investor, protected the position by having the long put strike. The stock, okay, is set to close below the long put strike. And I'm talking about inside 4 to 10 days till expiration. Notice it does not say, oh, on the last day of expiration with 1 hour remaining. Look, now you're kind of playing the game of less liquidity typically on those options, typically, okay? And now what you're going to see is what some investors say is hey, look, if the stock is below the long put strike, The risk of this is we got to now ask ourselves the question, is this stock still in an upward trend? If that stock is below the long put strike, and I got to close this out in a minute here, if this stock is below the long put strike, the investor might say, I don't really want the stock anymore. Some investors consider, okay, selling the long put, buying callback, selling shares. Why? Because they're actually thinking the trend has changed. That's not a great sign if that long put closed below the strike. What we're going to do in our examples of doing these collars and closing, we're going to practice kind of using these management sample ideas. Let's practice that together. Okay. Now, what I want you to do is I want you to continue practicing those collars. And then we're going to use these steps 1, 2, 3, and I'll talk about the fourth one tomorrow morning. Now, remember with what we discussed here today, we talked about Coin, we talked about Palantir, we talked about MicroStrategy, and we talked about Hood. We also talked about some of the sample management considerations with a collar. Now, stay tuned for Cameron May coming up at the top of the hour. Subscribe to the Trader Talks channel. Why not? All you got to do is click on it. Okay, it's free. And also remember that you can follow Ben also on X as well. Now, remember with what we discussed, it was done for example, illustrative purposes only. Thanks to Ben and thanks to all of you. And I wanted to kind of get to kind of some of those comments on the collar strategy as a follow through from last week on Monday and Thursday. And we're hitting it again to just hammer it home. So thank you so much for attending this class on trading with technical indicators. We'll watch these trades going forward. Go out and practice in the paper money account. Thank you. Have a great day. Bye-bye.